everyone. Welcome. My name is Clayton Johnson from Squire Wealth Advisors, and with me today I have Nathan Larson, also one of our advisors at Squire Wealth Advisors. Thanks for joining me, Nathan.
Yes, happy to be here today.
Great. We wanted to spend just a little bit of time today to talk about what happened in the markets last year and in Q4. Just as a recap, because it's been a long year, there's been a lot of things that happened. If you remember from the beginning of the year, collapse of Silicon Valley Bank, um, government shutdowns, threats of government shutdowns, a lot of progress in AI, just a lot have been going on, wars that have started, a lot of political turmoil, impending election year. There's just a lot that's impacted markets. So it's no surprise that people may feel a bit anxious right now about what's going on in the markets. And what Nathan and I are hoping today to address is the markets are behaving as expected. And really, you can look at this and recognize that the markets take all that information, they price it in, and we've seen some really good results and return on our investments in the markets, despite all the negative things we seem to be seeing. So Nathan, can you walk us through a little bit what happened in Q4 as far as performance of specific asset classes and maybe just last year in general?
Yeah, so we finished the year. Quarter four was a really strong year. We had a big rally in the markets. The U.S. market was up over 12%. The international markets were up. The bond markets were up. Everything was up in Q4. And overall for 2023, it was a very strong year in the markets. You can see that the U.S. market was up 26%. Um, Now it's a little misleading because if you go back to 2022, the U.S. market had a down year, but a really strong recovery in 2023, and a lot of that recovery came in quarter four. One thing that's important to remember when being an investor is you have to be in the game all the time in order to get the returns when they happen. And so if you're trying to time the market, be in and out day to day or quarter to quarter or year to year, it's almost impossible to capture the returns that the markets provide. Disciplined investors always get rewarded in the long run. And just as an example, if you think about tennis, arguably the best tennis player around is Roger Federer. And if you kind of break down the tennis game, there's points, sets, and matches. And Roger Federer, the best tennis player out there, he wins 54% of his points. And if you go to the next level of sets, he wins 75% of his sets, and then ultimately 86% of his matches. And this is the best player in the world. If you kind of relate that to the what's
Oh,
that?
sorry, Nate, just to interrupt. I mean, that's incredible. Well, 54% doesn't seem that great. That's like almost like a flip of a coin that he's going to win any
Yeah,
given point,
slightly
right?
better than a coin flip. Um, and what's interesting about that example is it's very closely related to the stock market. So any one day, if you study all the days historically in the market, 53% of those one days the market's up. That means 47% of the time the market's down on a one day basis. If you go to the quarter, it's 70% of the quarters are positive. And then when you go to the annual, 78% of every year, the stock market returns positively for investors. And so the challenge is just that discipline aspect. It's hard to stay in the market when you see it go down 47% of the days. But if you really take a long-term approach, the odds are in your favor. Stay disciplined. The market has historically rewarded investors, and that's what we expect going forward. And so last year, a nice recovery from the year before, and Q4 was very, very strong. So great news for investors, and a lot of the news is going to be negative. It's always been that way. The market's going to do its thing, and the key takeaway here is just to stay disciplined.
But such a good example. I love that because, I mean, like you said, Roger Federer, arguably one of the greatest to play the game of tennis. And it's shocking to think that on a point by point basis, he's only winning 54% of the time, but the market's the same way. That's great. We wanted to spend a little bit of time to go a little bit deeper into the investments. We're giving you kind of a high level look on how they worked on the U.S., international, emerging. We want to show you here an image of uh, breaking down more specifically certain asset classes and premiums in the market. So when we say premium, there's certain parts of the market that have historically outperformed others. The most well-known premium is the market premium, meaning if you invest in stocks versus investing in bonds, you're expected to get a better return investing in stocks. And the premium is somewhere around 6, 7, 8% if you invest in a stock versus a bond. Well, there are other premiums in the market. Premiums like value companies, small companies. For example, it's a lot easier for a small company to double in revenue than it is a large company. And so their expected performance over the long run is higher, even if there's a bit more volatility. So we track these premiums and we like to tilt towards them in a number of our portfolios. And as you can see here, one of the premiums that we really like is a small value premium. Typically over long periods of time, we're talking 10, 15, 20 years or more, you find that small companies and small value companies outperform large growth companies. And the last 10 years have not been very good evidence of that. I mean, Nathan and I are constantly talking about, it seems like tech stocks and large growth stocks are just doing unusually well. And their average over the last 10 years has been really good. And small value.
It's important to remember with that point. It's not that the small value companies have done bad. It's just that the large growth companies have way been outperforming their averages.
Yeah, exactly. So large growth averages, I don't know what it is off the top of my head. Usually it's like 8 to 10% or something like that. Historically, that has not been the case the last 10 years. It's been much higher. And we believe, and the philosophy that we subscribe to is that, there's a reversion to the mean, and that's not a sustainable long-term investment approach of large growth. And so you can see here on this chart, the last quarter, Q4, small value showed a substantial premium over a lot of these other parts. So we just wanted to emphasize, small value did well, large growth, which we were just talking about, had a good return. Really everything returned very well, but it was led by the small value companies out there. So Nathan, we've talked about stocks. A lot has happened in the bond market, interest rates. Tell us a little about what's been going on in the interest rate market and the bond market and all that.
Yeah, as we all know, we had some pretty high inflation recently. And in order to kind of combat that inflation, the Federal Reserve started raising interest rates very quickly. And we had a huge raise in interest rates from basically 0 up to 5.5% at the Fed funds level. And that rate was needed. Those rate increases were needed to reduce inflation and try to slow it down a bit. But what's interesting, we're kind of at a point where the overall market is expecting that interest rates will decrease over time a little bit, not a lot, but a little bit. And we don't. This is the same as predicting stocks. We can't predict when interest rates are going to go up or down and by how much. But we are in an inverted yield curve environment, meaning it's you get a higher yield from an interest rate perspective on shorter term fixed income investments than you do on longer term, and that's sort of backwards from what a typical interest rate curve looks like. And all it really tells us is at some point in the future, the collective wisdom of the market is expecting that interest rates are going to come down. And the key for us as money managers and for investors is let's not let that worry us or change our plan. We want to stay intermediate on term and capture some of the higher yields on the shorter end things, but also lock in interest rates over, if we go a little bit further out on the term, and we just take a balanced approach there so that we're capturing both sides of it. And that's just kind of where we're at. So the good news is that savers and retirees that are dependent on some of these fixed income investments, we're actually getting great bond rates now. And if you roll the clock back 3 years, it was really tough to get any yield on bonds. And now we're kind of in the 4 to 5.5% range. So positive outlook on bonds from where we've been.
Yeah, it's been great. Well, Nathan, thanks for joining me today. Really, we just kind of want to reiterate that what the market's doing right now is exactly as expected. Despite the bad news or the good news, the market prices that in, and we get what the market's expecting as far as our return. And it's been great. It's been great the last quarter and the last year, and we can expect that 53% of the time on a given day, we're gonna do better on a 70 something percent on the quarter and 80 something on a year. And it just keeps going up the longer that we stay invested. And that's the real key to a good financial plan. A good investment strategy is stay in the game, stay involved. And if you try to time it and get in and out, it really ruins the plan. So again, Nathan, thanks for joining me today.